new week opening gaps. NWOGs. It doesn't sound right. NDOG sounds cool. It's like, yeah, blood, what's up? NDOG, yeah, what's up? Here's NDOG, give me 5, bro. Yeah, that's cool. NWOG kind of sounds like an Ewok. Fucking, something wrong with that guy. Something wrong with him. But the information that it gives you, okay, that information is gold, because the markets are going to do what with them? They're going to act as magnets. So if you have one element of a turtle soup that is a change in the state of delivery that causes a directional change that's going to be sustained, okay, that's a reversal pattern, then you have turtle soups that are entry techniques that are part of an existing price run that's still yet to be completed. Meaning that we can look at all the run from here down to this low here, and anything that sees a short-term high pierced, not just by the wicks, not just by the wicks, the bodies. That's why I'm not teaching Linda Raschke and Larry Connor's turtle soup. This right here is not that pattern either. Go look at it. I'll tell you in a very simplistic way. The book Street Smarts has a pattern. There's two of them. There's turtle soup and there's turtle soup plus one. And all it is they look for a 20-day high. And if it trades above a 20-day high, they will fade that and go short. And they have a very short profit objective. To me, it's infantile. It really doesn't make any sense. But if for short-term trading, like getting in, getting out, real easy, no-brainer type things, if it's going to fail at a 20-day high or low, and I don't trade this, folks, like I don't trade that pattern. There's got to be something else. But for that book, that's all they had. And then there's 20 days plus one, which is basically the same thing, just one more day. And reverse it. They look at an old 20-day. What's the lowest low in the last 20 days? If it goes below that, they're going to buy that. Well, that's not enough information for me. And just as well as they try to capitalize with the name, which is really clever, they try to capitalize on the low hit strike rate of the turtle traders that Richard Dennis trained, because he used that 20-day breakout system. They would buy 20-day highs, and when it was a long-term trend, it would just keep on going, and they would make their money there. But they had a lot of losing trades that the 20-day high breakout would fail, and it would go back into the range and stop them out. So they had a very, very low strike rate. If my memory serves me right, it was less than 38% accurate. So how many times are you going to stay with a trading system that has that low of a success rate? Chances are you're not. You all think you're going to get 198% and all that shit. That's not going to happen. For your first couple years, you should be tickled to death if you're less than 50% accurate and you're still profitable. That's a huge Olympic win, because most people can't even get that. You can be profitable and have a very low strike rate, but it takes the mindset of understanding that it's about making money. It's about staying solvent. It's about following rules and not blowing the account. But it's so easy to go on tilt and lose sight of what it is you're trying to do, and lose sight of these building blocks, these stepping stones to, okay, well, this is what I'm going to use, and if that one transaction fails, it's okay. I'm going to go back tomorrow, and I'm going to wait for these things to be there again, and I'm not risking a lot. So Caleb can do every execution when he starts trading, but he can't risk more than 1%. But with turtle soups that are part of an existing price run, not a change in a direction like we have here, you have turtle soup entry mechanisms for your trades. Well, can you think of one without having to go on to any detail further right at this moment? I want you to think about it for a second. What did you learn from me thus far? Maybe in this mentorship this year, maybe it's in other lectures and things I've had on the YouTube channel, or maybe I taught about it in a Twitter space when I was on Twitter. What concept do you think would be one example of a turtle soup that's an entry technique in a trade that a existing trend or momentum or seller buy program is underway with? Can you think about that? What do you think it is? Institutional order for entry drill. Ooh, how about that? We have that in the form of, we have an old high here. See that? Why is this high being utilized anyway? Because it's a fair value gap. Every time I go into a short on a fair value gap, or if I go long on a fair value gap, my mind is I'm trading an inefficiency with a mechanism of entering with a turtle suit. So I'm buying below an old low. So if I'm, like for instance, I didn't take this trade, so just for full disclosure. Let's say that I was seeing this at the time, okay? And I want to take a trade, and I want to be a buyer. I'm going to use this candlestick here, the high. Why am I using that? Remember what I was talking about earlier? Look at the wick. It's overlapping inside the top end of that candlestick. That makes that small little, I'm going to have to zoom in. I know you guys can zoom in on your YouTube, but I want to really get in here and kind of give you the brass tacks to this. Because if I'm going to teach it right. So we have this candlestick run up, and then we have this portion where we opened and traded down. You might look at this and say, well, why don't you have this and this? That's something entirely different. This is a normal run-of-the-mill ICT fair value gap. This is what you get when you watch one video and you think you know everything about it. You don't. Just like when I teach a volume imbalance, okay? If I teach you to use a volume imbalance when there's a fair value gap in formation, that means that there's a separation between one candle body and another candle's body that is inside of the fair value gap. We don't have that here. But what do we have? We have an overlapping of this candle's high. It's all body. And then we open, we trade down. It overlaps this little portion in here. But there's no wick there. You see that? Big telltale sign. What's occurring there? It's flush and one little tap down. So, and I highlight this. I'm highlighting that. You're thinking, I guarantee you, I probably got comments right now, and they're probably going to go in there and delete it now. They use my most recent post on my community post. You're drawing the fair value gap wrong. No, you're not. You don't know what the fuck you're talking about. This is how I would classify this inefficiency. But I have to encapsulate it here because this is a balanced price range between this low and that candle's high. That is a PDA array that you've never learned before. It's the first time I'm introducing it. Just like when I introduced the inception of the volume imbalance, when there's a gap, a fair value gap, you have to incorporate that because that's the real range of that inefficiency. This inefficiency here, you have to refer to that as well. Notice it doesn't even get down into that gap below right there where it was like this. There's nothing there. It's just a gap that stayed open. Yeah, wonderful. But that's not the narrative. The narrative is you have a balanced price range here inside of a fair value gap. So that's why the market goes down to that level there and sends it higher. So in case you were watching me earlier explain this, because I was in a rant, you were probably thinking, oh, this doesn't make any sense. No, you don't know all the details. This is why you can't get a 5-minute trainer. You can't get a dollar mentorship mentor telling you this stuff. They don't know. They don't know. Okay, I promise you, they don't know. And if you're not learning from me, you're getting watered down bullshit. You're not getting the real details, and it ain't gonna work for you. So extending that over here, that's the range. But if you have this candlestick here for that gap from here to here, see that? That gap is part of the sell program. It's formed as it dropped. So those are going to always be the most important ones. I'm watching that because what I'm watching is I want to see, does it converge and agree with something that's over here that formed as a basis for taking a trade. Okay, let's say that we did not have this gap again, and say we didn't have this gap and this gap. What over here would be in agreement with this 6 o'clock time? Remember yesterday at 6 p.m. we have to annotate that either with the new day opening gap if there's a distinction between the 5 p.m. closing price and the 6 p.m. opening price, because there's that 1 hour gap in price and trading. They don't trade between 5 and 6 o'clock. We always annotate that as a new day opening gap. But if the 5 p.m. closing price or settlement price is the same as the opening price at 6 p.m., all we do is draw a single line, and you can label it whatever you want. If that's all we had there, and we didn't have the inefficiency in this form of this gap here, and we didn't have that one here, what else would be there? And let's say we didn't have this wick. Here, say we didn't have that. What else, if it was retracing up, what else would I lean on? I would use this, obviously, but it could trade through them. Remember, it can spike. It can cause candlesticks like it did here to have the wicks. What is it doing? Look to the left. It's part of the buy side of the curve. What do you see? Don't look at my cursor. I'm not putting my cursor on it to give you any help. I want you to try to think about it and tell me what you see. Obviously, I can't see. I can't hear you. But isn't this a wick? See that? So what do you do at wicks like that? Ignore them? Oh, it's a doji ICT. You're reinventing. Bullshit. Come on, Steve Nielsen, guys. Watch this. Steve Nielsen's the candlestick god. Puny god. Here's the halfway point of that wick. That's pretty fucking random, isn't it? It went right to that as well. And even if you didn't have all these other things, if this candlestick went up and stopped short of that, that means I absolutely know with a great deal of confidence that the next candle, when it opens, I want to trade into the body of this candle. And as soon as it does that, that's going to be treated as a bearish order block. Not because it's an up-close candle, but I'm trading it because it's inside of the range of that candlestick. Remember I was telling you many times in rants, many times on Twitter Spaces, I can trade inside of an order block before anybody else would recognize it as an order block, or they want to call it a supplier demand zone. I'm trading inside of the candlestick that will later on be obvious in hindsight to someone else. Oh, that's an order block. But you were entering before the order block. How do you know how to do that, ICT? You're getting all the answers in 2024, baby. All you got to do is show up. Just take some fucking notes. All the information is being disseminated to you. Like a fire hose, okay? Don't complain when it rips your fucking face off. Just be thankful you're getting a drink. That wick, that consequent encroachment, extended on over here. So how many things are you seeing converging right there? Lots. That tells you that this retracement here is going to send price lower. That's why I said I want to see it now go down into, go back and listen to the stream. It's going to be there. I can't change it. We're going to look at it and see if it can reach down to the lower quadrant. And it gravitates from here down to that. Then what does it do? It returns back to the midpoint, consequent encroachment of that wick. See how that works? Boom. Oh, this is classic support and resistance. No, it's not. It's not supply and demand. It's technical science. Anton Creel. It's technical science, baby. You know he's fucking watching these videos. If someone tells you that they can tell you what's going to happen in intraday charts, run away from them. They're a con man. They can't do it. They're not. Well, what do you do with us? It's a whole bunch of us doing it. Market trades out to that and then trades down to the low and explores below the low, which is what we have here. Okay. Now, with that said, I've exhausted everything to do with the buy side of the curve over here. Then the rest of it is just simply using the rejection block and the actual low. Okay, so we went through all the PDA rays from that high going backwards inside the range. So that's trading inside the range. So my question to you is, out of all those things there, which element is your multiplier? What's the one that you see right now? I'm not saying that you can go out and take a trade with it. It doesn't mean that you can go out there right now in front of the whole world, live stream, and do entries with it. That's not realistic for you to expect that. I wouldn't expect that out of you. But which one did you see